Hello, I'm Sebastian. Welcome to 9 Trees podcast. Today, I will summarize and review the book. John J. Murphy's study guide to technical analysis of the financial markets is designed as a structured companion to his widely used reference on charting and market behavior. Published within the New York Institute of Finance series, it focuses on helping readers learn the language of technical analysis through organized review, practical exercises, and application-focused prompts. The study guide follows the core logic of technical work. Prices and volume encode crowd psychology, trends persist until proven otherwise, and patterns can be analyzed across timeframes and asset classes. Instead of presenting technical analysis as a set of tricks, it frames it as a disciplined process for identifying trend direction, judging momentum, managing risk, and timing entries and exits. Readers can expect coverage that connects classic chart principles to indicators, intermarket relationships, and real-world trading decisions. It suits self-learners preparing for trading or market-related roles, as well as experienced practitioners who want a clear way to test and reinforce foundational concepts. I will give you key takeaways from this book. Firstly, core principles, price action, trends, and market psychology. A central theme reinforced throughout the study guide is that technical analysis begins with the observable record of the market itself: price, volume, and time. The material emphasizes how technicians interpret these variables as an expression of collective behavior, where optimism, fear, and uncertainty show up as trends, ranges, and turning points. The guide trains readers to define trend direction objectively, using tools like swing highs and lows, trend lines, and basic rules for uptrends and downtrends. It also clarifies why multiple timeframes matter. A short-term countertrend can exist inside a larger primary trend, and trading decisions improve when those layers are aligned. Equally important is the idea of confirmation, where a price move gains credibility when accompanied by supportive volume or broad participation. By drilling these foundations through review and practice, the study guide helps the reader move from vague pattern spotting to structured reasoning. What is the trend? What would invalidate it? And what evidence supports the trade idea? This mindset becomes the backbone for every later indicator or method introduced. Secondly, chart patterns and support resistance as decision frameworks. The study guide highlights classical chart analysis as a way to translate market structure into actionable plans. Support and resistance are treated not as fixed lines, but as zones where previous trading activity created memory in the market. Readers learn to interpret how price behaves near these areas, including the common role reversal, where old resistance can become new support and vice versa. The guide also revisits major reversal and continuation patterns, encouraging readers to focus on context and confirmation rather than memorizing shapes. Pattern analysis becomes more useful when paired with expectations, where a breakout should occur, where a protective stop could sit if the idea is wrong, and how to judge whether a move is likely to follow through. Another practical element is differentiating between healthy consolidations and signs of distribution or exhaustion. By emphasizing clear invalidation points, the study guide helps traders avoid overconfidence and instead treat patterns as probabilistic setups. This topic ultimately frames chart patterns as a planning tool, identifying the battlefield, measuring risk, and mapping scenarios rather than predicting the future with certainty. Thirdly, indicators and oscillators, measuring momentum and conditions. A major portion of technical study involves indicators that compress price and volume behavior into interpretable signals. The study guide supports this by organizing indicator use around the question each tool is meant to answer. Trend-following measures such as moving averages help define direction and smooth noise, while momentum oscillators such as RSI or stochastics help evaluate speed, overbought or oversold conditions, and the likelihood of mean reversion. The guide underscores that no indicator is inherently right on its own. Effectiveness depends on market regime. In strong trends, oscillators can remain stretched for long periods, so traders must avoid treating overbought as an automatic sell. Conversely, in ranges, oscillators can be more reliable while trend tools may whipsaw. Another important emphasis is divergence analysis, where momentum fails to confirm a new price extreme, potentially signaling weakening trend energy. The study guide encourages readers to use indicators as secondary evidence, not primary drivers, and to build simple rule sets that can be tested and repeated. This approach helps reduce subjective interpretation and improves consistency in entries, exits, and risk control. Fourthly, volume, breadth, and intermarket analysis for confirmation. Beyond individual charts, the study guide addresses market internals and cross-market relationships that can strengthen or weaken a technical conclusion. Volume analysis is presented as a way to gauge commitment. Breakouts and trend continuations are typically more convincing when participation expands, while weak volume can hint at false moves. Breadth indicators extend the idea by assessing how widely a move is shared across a market, such as the difference between a narrow rally led by a few names and a broad advance supported by many stocks. The guide also connects technical analysis to intermarket thinking, where stocks, bonds, commodities, and currencies influence one another. For example, shifts in interest rates can affect equity valuations, currency trends can impact commodity prices, and sector leadership can reveal risk appetite. The practical benefit is not perfect prediction but better context. A bullish chart in isolation may be less trustworthy if related markets are sending conflicting signals. By practicing confirmation across volume, breadth, and related asset classes, readers develop a more resilient process that filters marginal trades and improves timing when multiple pieces of evidence align. Lastly, trading application, system thinking, risk management, and discipline. The study guide pushes technical analysis toward real trading decisions by emphasizing structure, rules, and risk control. Readers are guided to think in terms of setups, triggers, and management rather than isolated indicators. This includes defining entry criteria, selecting stop placement based on market structure, and establishing profit-taking logic that matches the type of trade, such as trend following versus swing trading. Position sizing is treated as a crucial bridge between analysis and survivability, because even a strong method can fail if risk per trade is too large or inconsistent. The guide also reinforces the importance of expectancy, the idea that a method should be evaluated by its long-run outcomes rather than a handful of wins or losses. Alongside mechanics, the theme of discipline appears repeatedly: follow the plan, accept uncertainty, and avoid emotional chasing. By encouraging repeatable processes and post-trade review, the study guide helps readers turn technical tools into a coherent approach. The result is not only better chart reading, but a framework for acting responsibly in real markets where outcomes are probabilistic and risk is always present. In conclusion, this study guide best fits traders in training, finance students, and self-directed learners who want to master the essentials of technical analysis through structured review and application. It is also valuable for experienced market participants who know many tools but want a clearer framework for when to use them and how to confirm signals. The key life benefit is practical decision-making under uncertainty. Readers learn to define scenarios, set invalidation points, and manage risk, skills that transfer to other high-stakes choices where emotion can distort judgment. Compared with many technical analysis books that either overwhelm with indicator catalogs or oversimplify trading into shortcuts, this guide stands out for its organized, study-oriented approach. It reinforces foundational concepts, ties tools to specific questions, and encourages disciplined thinking rather than prediction. Because it is designed to support learning and retention, it can reduce trial and error in the market by helping readers build a repeatable process. For buyers choosing among similar titles, the value is in its companion-style structure. It helps you practice, test yourself, and convert theory into usable trading habits. If you would like to support John J. Murphy, you can buy the book through the Amazon link I've provided in the podcast description. After reading the book, please let me know what you think and share your thoughts. See you around.